Welcome back to Muffet Investment Views. Today, we present a short video on hedging a portfolio using options. As we head into the presidential elections, the risks of corrections are high, but no one can know for sure if we will end up having a correction. Instead of selling our positions, we can use options to mitigate some of the downside risks. This video is for investors who are well-versed in options trading. In the future, we will produce videos on the basics of options trading. We are seeing increasing divergences in the indices. As presented in the previous video, the Dow Jones is showing weakness. However, both the S&P and Nasdaq are in strong uptrends. Until we see a clear market structure break on the daily chart, we will have no confirmation of a correction. But the best time to buy options is when volatility is low, and that's why we have chosen this time to do the hedging video. Again, this is not investment advice, but we want to produce this video as an educational opportunity at an important turning point in the market. We will use sqqq to hedge the portfolio. sqqq is 3 times the inverse Nasdaq. This means that for each 1% downside move in Nasdaq, sqqq will move up 3%. So if we have a 10% correction in Nasdaq, then sqqq will move up 30%. The sqqq is currently trading at $7.40. Now here is the big deal. We are going to buy bull call spreads on sqqq by selling a long-term put option on a stock we want to own. When we sell a put option, we collect a premium. We use this premium to buy the bull call spreads on sqqq. In this case, we are using Rio Tinto, which is one of Muffet's favorite stocks. It is currently trading at around $67. Here is how we do it. Here are the December 2024 call options chains for sqqq and the January 2026 put options chain for Rio Tinto. Please note that the expiry dates are different here. We sell 2 of the Jan 2026 $60 put option on Rio Tinto trading at $5.51 each at the end of trading 9th July 2024. We collect the $5.51 premium. As we are selling 2 options, the total premium collected is $11.02. As each option is worth 100 shares, the total premium we collect is $11.02 asterisk 100 equals $1,102. This also obliges us to buy 200 shares of Rio Tinto at $60. Because of the queerness of the option buyer will only obliges us to buy the shares if Rio Tinto trades below $54. We use the premium collected to buy 20 of the December 2024 $7.09 bull call spreads. This means we buy 20 of the December 2024 $7 call at $1.25. We also sell 20 of the December 2024 $9 calls at $0.70. The total cost of one spread is $0.55. The total cost of 20 of these is $11. As each option is 100 shares, the total cost is $1,100.
As we have collected $1,102 for promising to buy 200 shares of Rio Tinto, in effect, we have bought 20 sqqq bull call spreads for no money at all. To keep things simple, suppose Nasdaq falls 10% before December 2024, the sqqq will rise 30%, which means the share price of sqqq will be above $9. This means we collect $2 from each spread. As we have 20 spreads, we will collect 2 times 20 equals 40. As each option is worth 100 shares, we would have made 40 times 100 equals $4,000. Now, depending on the size of your portfolio, you can adjust the number of spreads that you want to buy. We have used Rio Tinto as an example, but you can use put options of any companies that you want provided you are happy to buy them if assigned. This means that if we do have a correction in the short term, the portfolio is protected to a certain extent, and if we cash the spreads, we will have money to deploy to buy stocks at lower levels. We hope this has been educational, and we would like your feedback on this. Please like, share, and subscribe for more of the same.